Royal Bank of Canada looks, on paper, like a bank in control of its situation. It is raising price targets, it is reiterating outperform ratings, its dividend growth narrative is intact. And yet, the macro environment surrounding every Canadian bank right now is assembling the conditions for a stress test that no quarterly earnings report has fully priced in. That is the tension worth sitting with. Canadian financials do not move in isolation. They are expressions of the Canadian economy, and the Canadian economy is walking into one of the more complicated periods it has faced in years. U.S. tariff escalation is not a background risk anymore. It is an active force reshaping trade flows, corporate confidence, and the earnings capacity of the businesses that Canadian banks lend to. When corporate borrowers feel pressure, credit quality follows with a lag. That lag is what makes bank stocks feel calm before they don't. The housing market adds a second layer. Canadian household debt relative to income has been among the highest in the developed world for years. That was manageable when rates were low and home values were rising. The rate environment changed, home values in key markets softened, and now, with recession probability rising, the refinancing cycle that millions of Canadian homeowners are entering looks meaningfully more dangerous than it did 18 months ago. Royal Bank, as the largest mortgage lender in Canada, carries that exposure more than any other institution. This is where the standard analysis stops. Most commentary on RBC right now focuses on its dividend yield, its capital ratios, and its diversification into U.S. markets through the City National acquisition. These are real strengths, but they also obscure something. City National was not a clean acquisition. It required significant remediation work following regulatory criticism around risk management gaps. Royal Bank absorbed those costs and has been rebuilding. What that means is that the U.S. diversification story, the one analysts point to when arguing RBC is insulated from Canadian macro stress, is partially offset by a U.S. subsidiary that is still in a recovery and rebuild phase. The hedge is real, but it is not as clean as the headline diversification argument suggests. Meanwhile, Manulife is pursuing a different strategy. Its new global wealth and retirement partnership signals an intent to grow fee-based revenue streams that are less sensitive to credit cycles. That matters because it highlights the strategic fork between Canadian financials right now, institutions moving toward asset-light, fee-generating models versus those still heavily weighted toward balance sheet lending. Royal Bank sits firmly in the second category. TD Bank does too. The macro stress lands differently on those business models. Now here is the reversal. The consensus view treats Canadian bank stress as a housing story, but the more important transmission mechanism right now may be small and mid-sized business credit. Canada's trade-exposed SME sector, manufacturers, logistics firms, agricultural exporters, is facing direct margin compression from tariff-driven input cost increases and reduced access to U.S. markets. These borrowers don't make headlines. They don't generate the same political urgency as homeowners, but their credit performance sits on bank balance sheets, and deterioration in that segment tends to arrive quietly and accelerate quickly. Royal Bank's decision to cut its price target on BRP, a Canadian recreational vehicle manufacturer deeply exposed to U.S. consumer demand and tariff dynamics, is a small but telling signal. When your own research desk is marking down the companies that represent your lending and economic environment, the internal view of that environment is worth noting. The scenario branching from here splits on one condition: whether the Bank of Canada has enough room to cut rates meaningfully before credit stress becomes visible in earnings. In the path where rate cuts arrive early and with sufficient magnitude, Canadian mortgage holders get relief, business borrowing costs fall, and the housing market finds a floor. In that scenario, Royal Bank's dividend strength and its long capital position become genuine assets. The stock's current underperformance relative to the broader market starts to look like a buying window rather than a warning. In the path where tariff escalation deepens before monetary policy can respond, or where the Bank of Canada moves cautiously out of concern for the currency, the lag between macro deterioration and credit loss provisioning starts to close. That is when the dividend narrative gets complicated. Not broken necessarily, but complicated. Provisions rise, earnings compress. The 30-year financial stability story that defines RBC's identity gets tested in real time. The evidence right now leans toward the second path, carrying more near-term weight, but the recovery path is not a distant scenario. It is one policy decision cycle away. What makes Royal Bank specifically interesting, rather than just the sector broadly, is the combination of its size, its mortgage concentration, and its ongoing U.S. integration work. It is the institution where Canadian macro risk is most legible and most concentrated. Watching how its provisioning trends evolve over the next 2 quarters will tell more about the health of the Canadian economy than almost any other single data point. The dividend is real, the capital base is real, and the stress building underneath both of those things is also real. The question is sequencing.